Hey everyone, and welcome back to How to Spend It. Does tax season cause you a sense of dread in the pit of your stomach? Do you worry about whether you have held on to the receipts from the past year and if you will get a return or maybe have to fork out the cash? Well, hopefully this list will help ease your mind and save a few dollars in the long term. Today we are going to be talking about the top 10 ways to reduce your taxes in the United States. And if you think you're clever, wait until you hear about number 1. But before we get onto that, go ahead and like and subscribe if you haven't already. It helps us out a lot and lets us know that we are helping to enrich lives out there. And without any further ado, let's get on to the video. Number 10. Selling losing investments. To begin our list off with number 10, if the investments you have tucked away have been experiencing more losses than gains, it might just be an idea to cut ties and sell them off. In order to qualify for the deductions, the taxpayer must have taxable gains and losses, as some investments do not offer this as an option. You can use the loss to offset capital gains, but if the loss exceeds the gains, then you can use it against ordinary income. By harvesting the losses, it can also help to lower the taxable income by roughly $3,000 US, though it can change depending on the different circumstances. Number 9. Income shifting. Shifting on to our next point. Get it? Shifting? Anyways, moving on to number 9. The option to help reduce your taxes can also be viewed as income splitting. The idea is to make a portion of the earnings for the year and move it from a high bracket to a lower one. A form of this can be an adult moving a trust into a child's name, which will reduce tax liability and decrease the adjusted gross income for the taxpayer. This is absolutely legal. And now wait until number 5 if you want to hear a great tip. Number 8. Paying medical bills. Bills, bills, bills. Not just a Destiny Child song. We all have them. If you have to go and see a medical professional frequently, then this tip will help you. There are some requirements if you're going to try and claim the chiropractor or massage therapist bills come tax time. You will need to itemize the different services, and should they equal at least 10% of what you have made that year, then you can place the deduction on your tax forms. If they fall below 10%, then you won't be able to submit for that year. But there may be tips farther in the list that can help you with these. Number 7. Deduct every business expense you're entitled to. In this day and age, not everyone needs to leave their home to get to work. Many companies have offered the idea of working from home at a computer provided to them by the company. You may not think that there is anything then that can be deducted towards taxes, but if you know the IRS rules for this, you can submit the expenses of a desk to work at and even an ergonomic chair to avoid strain from working. Even if you work in the office, there are expenses that can be submitted to help with deduction. These could be the gas used to visit clients or even office supplies like paper and whiteboard markers needed day to day. Number 6. Bundling your deductible expenditures. Taxes can cause a bundle of nerves, but by bundling your deductible expenditures, those nerves might just ease up. This tip may also help, as I mentioned previously in point number 8. When compiling the different expenses you have had over the year doesn't quite meet the minimum 10% of your income needed, this option may be what you're looking for. Combining 2 years' worth to rise above that minimum and being submitted in a single year will show a decrease if you need to pay any taxes when it is all done. For example, if you have spare cash around after donating to different charities over the year, then paying that amount in December for the following year can be submitted under the single year. It will surpass that 10% of your income and perhaps ease those nerves that are jittery. Number 5. Earn tax-free income. Our halfway point today focuses on the idea of earning an income that does not require you to be taxed. Different ways this can be used is through perhaps selling a primary home, depositing money into a tuition plan, or investing in bonds. By building up these different methods, the income that is taxed by the end of the year will not be as high and less stress may be caused. This is also legal, but wait until number 3 for another great idea. Number 4, contribute to a flexible spending account. A flexible spending account, or FSA, is a great thing to take advantage of if your employer offers it to you and fellow colleagues. By contributing to this particular account, you can use pre-tax funds to pay out of the pocket for different medical expenses. Other uses of this account can be by making it a dependent care account for childcare while you're at work or for a disabled relative that needs aid when you're not around. You will want to be sure to enroll in this if it is offered during the enrollment period, or it might just go poof. And you will need to look into number 3 for a tax-saving idea. Number 3, save for college for your kids. We have reached the top 3 contenders in the game of taxes and reducing them. The plus side with this particular point is that not only does it help reduce your own taxes, but it helps the next generation. While this may not be deductible on a federal level, this may work at a state level for taxes. In 30 states, including Washington, D.C., you're allowed to open a 529 with the idea that the person will head off to college or university once they finished high school. This could be for your own children, grandchildren, nieces, nephews, or little ones of your friends that you hold near and dear. You can even open one for yourself if you have plans to attend college to expand on your knowledge and skills. However, hold out for number 1. Number 2, contribute to a 401k. We are nearing the finish line, but let's check out the number 2 point on this topic. If you have a 401k or an IRA, the contributions to the amount over time will help slash those taxes if you need to submit for the year. If you have a 401k in place, you can contribute up to $19,000 during the course of the year that will be taken into consideration for deductions. You can also submit an additional $6,000 catch-up to that account if you're over the age of 50. Every little bit adds up, and if you're able to max out the 401k and IRA contributions, it can deduce the taxable income by $25,000 or $32,000 if you're over the half-century mark. Now that we have gotten the last 9 out of the way, let's check out what our number 1 tip is. Number 1, donate to charity. Here we are with the last tip, but maybe the most worthwhile of the bunch. If you're able to donate to charities throughout the year, by the time the tax season rolls around, you will be able to apply that to the deduction section on the tax form. You will need to do up an itemized list of the donations and make sure that the charity you are donating to is a qualified charitable organization. Cash is not the only thing that can be donated to charities, but also stock or non-cash contributions can be counted as well. Well guys, that's it for this video. Click the links above to check out some of our other videos. Also, don't forget to like and subscribe for more content just like this. We have many great videos coming up, so see you guys in the next one.